In 2003, an average movie ticket cost around 40 rupees. Today, you are lucky if you find one for 300 rupees. That is a 650% jump, and let's be honest, the movies haven't gotten 6 times better. Welcome back, I'm Zoya, and I'm here to translate the financial noise into actual strategy you can use to build wealth. Take a look at Rahul. He is hoarding his savings in a basic bank account, genuinely thinking he is playing the system perfectly. Priya, on the other hand, is just stressing out because her daily iced coffee order just went up by 50 rupees again. What neither of them realizes is that inflation isn't just some textbook concept. It is a very real, aggressive leak in their bank accounts, actively draining their purchasing power while they sleep. If your money isn't growing by at least 6% a year, you aren't breaking even. You are mathematically getting poorer. Stick around because we are going to fix that. If you hide 1 lakh rupees under your mattress today, you might look at that stack of cash and think, wow, it is perfectly safe. I mean, nobody knows it's there, the door is locked, you're practically Fort Knox, right? But mathematically, in just 10 years, an invisible thief is going to sneak into your room and shred 60,000 rupees of it. Just completely gone. No alarms, no broken windows, the money still looks the same. But the power behind it? Poof, gone. And the most dangerous part? Your brain will still register that you have that 1 lakh. You'll feel secure, completely oblivious that the purchasing power of those notes has been hollowed out from the inside. Like a bad masala dosa. So today, we are tracking down that silent killer of your wealth. We are doing a massive, necessary financial vibe check on inflation. Because the reality is, the traditional ways our parents taught us to save money are practically guaranteeing that we end up broke. To break this down, I've analyzed macroeconomic data, 25 years of Nifty 50 reports, and behavioral finance studies. Plus, I have a real-world retirement case study for you later. The numbers are real and incredibly unforgiving. Our mission today? Give you the cheat code to outsmart this whole system. We are going to figure out how to stop taking a massive L on your life savings while you sit there thinking you're playing it safe. Because a lot of people do think they're playing it safe. But before we get to our characters, we have to understand the villain. We hear the government talk about inflation all the time. And honestly, the numbers they throw around, they don't sound that intimidating. Well, that's no accident. Headline retail inflation in India, the CPI, usually stays within a seemingly manageable range. Like recently, it's sitting between 3.5% and 5%. Even looking back a decade, the average is around 5.6%. I mean, yes, we had spikes over 12% back in 2010, but a 4 or 5% baseline just sounds like a slow, annoying leak in a tire, not a catastrophic blowout. If someone tells me my money is losing 4% of its value each year, my first reaction is usually, alright, I can live with that. It just doesn't trigger any actual panic. And the trap there? The CPI headline number is a massive composite. It is this massive basket of nearly 300 commodities. It averages out the cost of things you buy every single day with the cost of things you might buy once a decade or even things heavily subsidized by the government. So it's masking the real pain points. The real threats to your survival are specific inflations, the things you absolutely cannot opt out of. We're talking fuel, food, and eventually healthcare. Let's pull the data on petrol because this genuinely shocked me. If we rewind 20 years to 2004, the price of petrol in Delhi was around 34 rupees per litre. Fast forward to 2024 and it is crossing 100 rupees per litre. That is a 194% increase. And you know, it's not just about the cost of filling up your Activa. It hits everything. Every single item in your local market, every Amazon package, every Swiggy delivery requires fuel. When logistics costs rise, those higher expenses are quickly passed on to consumers, which helps explain why food inflation remains so persistent. The data shows a kilo of standard rice going from roughly 20 rupees in 2010 to over 40 rupees recently, and hitting 58 in certain metros. Toned milk doubled from 25 to 45. You can try to budget, but you cannot negotiate with your own metabolism. You have to eat. But while food and fuel steadily chip away at your budget, they are usually manageable if your income keeps pace. A big if, of course. But that brings us to the actual final boss of financial ruin in India. The thing that bankrupts entire families. Yes, that is medical inflation. And the numbers here are just terrifying. General inflation is floating around 5%, right? But medical inflation in India is consistently running between 14 and 16%. Every single year. It's staggering. You might be wondering, why is there such a massive disconnect? Why is healthcare getting so expensive so incredibly fast? Start with the infrastructure. A modern Tier 1 hospital demands enormous capital just to become operational. The cost of real estate and specialized infrastructure is eventually passed on to patients. Hospital technology is becoming increasingly expensive, with currency fluctuations adding to the cost. India imports over 70% of its high-end medical tech, MRI machines, advanced surgical robotics. All of these are priced in US dollars. So every time the Indian rupee depreciates against the dollar, the cost of acquiring and maintaining that life-saving equipment surges. When imported costs rise and the currency weakens, the impact compounds quickly. Add in the fact that skilled surgeons and specialists command global-level salaries now. It becomes a perfect storm to empty your bank account. Let's ground this in reality. I was running numbers through a medical inflation calculator. If a major medical procedure costs you 5 lakhs today and medical inflation stays at that 14%, in just 10 years, that exact same procedure will cost you 18.5 lakhs. Let that number really settle in for a moment. That is a 271% increase in a single decade. 271%. So if you're sitting there feeling super responsible because your HR gave you a health insurance policy with a 5 lakh cover, the math literally dictates that in 10 years, your quote-unquote responsible policy won't even cover a third of the hospital bill. You would be forced to liquidate your life savings or take on debt just to survive a standard medical emergency. It is brutal. To make this whole thing even more visceral, let's look at the rule of 72. For anyone who hasn't heard of it, it is a brilliant mental model. You just take the number 72 and divide it by the annual inflation rate. Super simple math, I promise. And the resulting number tells you exactly how many years it will take for your purchasing power to be cut completely in half. It is a phenomenal tool for cutting through the whole illusion of money. Let's try it. Apply the rule of 72 to the baseline 6% inflation rate. 72 divided by 6 gives you 12, meaning every 12 years, the money sitting idle in your savings account loses half its value. A 500 rupee note today effectively buys you 250 rupees worth of groceries in 12 years. Depressing but manageable. Now, apply that exact same rule to the final boss. Medical inflation at 15%. Do the math with me. 72 divided by 15 is 4.8, less than 5 years. Every 5 years, the cost of staying alive in a medical emergency doubles. So if the cost of living is doubling that fast, Keeping your money in a standard low-yield savings account isn't just conservative, it's active financial self-sabotage. You are financially ghosting yourself. You're letting the problem compound in the background until it completely wrecks you. Which brings us to the ultimate paradox of personal finance. This brings us to the ultimate paradox of personal finance. The strategies that our parents and grandparents taught us, the ones that feel so incredibly safe emotionally, are mathematically guaranteed to destroy your wealth in the modern economy. To really understand how this plays out in real life, let's dive into the core case study, our financial fable. Meet Mrs. Sharma and Mr. Gupta, two portfolios. They both worked hard, just retired, and crossed the finish line with a massive flex, a retirement corpus of 2 crores each. And let's be real, for the vast majority of people, 2 crores represents total financial victory. It is a huge flex. But this case study proves that the size of your corpus matters way less than the mechanics of how you deploy it. Let's start with Mrs. Sharma. She wants complete peace of mind, no market swings, no uncertainty, no surprises. So she locks her entire 2 crore rupees into a fixed deposit, securing a guaranteed 7% return every year. The FD is the historical bedrock of the Indian middle class. It promises certainty in a very uncertain world. So let's run the math on her first year. Her 2 crore rupees FD generates 14 lakh rupees a year in interest, while her annual lifestyle expenses total roughly 10 lakh rupees. Okay, so she has a surplus. She spends the 10 lakhs, keeps her massive 2 crore principal entirely untouched, and has a 4 lakh surplus left over. She is radiating main character energy right now. She thinks she has literally beaten the system. But that feeling of victory is a documented cognitive trap. Behavioral economists actually call it the money illusion. She mistakes nominal stability for real safety. Let's unpack that. The problem is that our brains naturally focus on face value numbers rather than what those numbers can actually buy. Mrs. Sharma logs into her net banking and sees 2 things. Her 2 crore balance has not dropped by a single paisa, and her 14 lakh income comfortably covers her 10 lakh expenses. So to her, everything is perfect. Her brain interprets the static data as total security. The mistake is failing to account for inflation. The money looks intact, but its purchasing power is steadily declining. She treats the 10 lakh cost of her lifestyle as a permanent fixed variable. But as we know, the fuel, the food, the healthcare will ensure that 10 lakhs buys less and less every single month. We will see the catastrophic results of her delusion shortly. But first, let's contrast her approach with Mr. Gupta. Our boy Gupta has the exact same 2 crores, but his strategy is radically different. He takes 40% of his money, so 80 lakhs, and puts it into safe debt instruments, kind of similar to Mrs. Sharma, just a nice boring buffer. The other 60%, amounting to 1.2 crore rupees, on the surface, this looks like a bold move for a retiree, and that's probably setting off alarm bells in your head. I have to push back on this. We see Indian Gen Z traders getting totally wrecked in the market every single day. They jump into futures and options. They try to day trade on their phones during college lectures, and they blow up their accounts in a week. If Mr. Gupta retires on a Friday, puts 1.2 crores in the market, and on Monday, some new global pandemic is announced, and the market crashes 30%, his equity just plummeted to 84 lakhs overnight. How is that not just reckless gambling with his survival money? The Monday morning crash scenario is important because it forces us to separate speculation from investing. Many day traders are trying to profit from short-term market swings. That's a very different activity from long-term investing. That's the exact opposite of what Mr. Gupta is doing. By investing in a Nifty 50 index fund, he's not wagering on short-term price movements. He is buying a proportional ownership stake in the 50 largest, most profitable, most dominant corporations in India. He owns a slice of the banks financing the country, the IT firms building the software, the pharmaceutical companies making the drugs, and the automotive companies building the cars. He basically owns the actual engines of the economy. He's not betting on a horse, he owns the racetrack. I can already hear the objection. What if the market drops 30% on Monday? And you're right, it doesn't stop short-term volatility, but we have to look at the historical mechanics of the market. According to the NSE reports in our sources, since its inception in 1999, the Nifty 50 Total Return Index, which includes the reinvestment of dividends, has delivered a compound annual growth rate or CAGR of 14.1%. 14.1%. Now, let's connect the dots back to our final boss. Medical inflation is running at 14 to 16%. And this is the core mathematical reality of retirement, guys. If the absolute most expensive mandatory cost of your later years is compounding at 14%, you are mathematically required to own an asset class that compounds at an equal or greater rate. A 7% FD is just mathematically defenseless against a 14% inflation rate, completely defenseless. Equity is not a luxury, and when held over a long enough time horizon, it's not a gamble either. It is the only shield capable of absorbing that level of financial heat. Let's talk about the mechanics of that CAGR for a second. Compounding isn't just like adding 14% on top every year, right? No, think of it like a snowball rolling down a mountain. In the first year, your snowball picks up a layer of snow. That's your interest or return. But in the second year, the snowball is larger. So when it rolls, the new surface area picks up significantly more snow than it did the first year. The return is generating its own returns. Over a 20-year horizon, the vast majority of your wealth isn't the snow you started with. It's the snow that the newly accumulated layers picked up along the way. Okay, so year 1 looks great for Mrs. Sharma. She feels totally secure in her Delulu money illusion. Mr. Gupta's portfolio is probably bouncing all over the place. Maybe the market dropped 5%, maybe it went up 20%. But what happens a decade later when the math actually catches up to them? This is where it gets dark. Now let's fast forward 10 years into Mrs. Sharma's retirement. This is where inflation begins to reveal its full impact. Let's assume a blended inflation rate of 7.5% over this decade. The exact same lifestyle, the same apartment, the same groceries that cost Mrs. Sharma 10 lakhs a year when she retired now costs her 20 lakhs a year. The problem is that her spending needs have grown while her FD income has stayed largely the same. The numbers no longer work. 14 lakh rupees comes in, 20 lakh rupees goes out, leaving a 6 lakh rupees deficit each year. With a persistent income shortfall, she's forced to dip into her savings. That's where the real strain begins. I imagine she justifies it to herself. She thinks, hey, it's only 6 lakhs out of 200 lakhs. I have plenty of buffer. I'm safe. But let me walk you through the math of a melting snowball. It is brutal. In year 10, she withdraws that 6 lakhs. So heading into year 11, her principal is no longer 2 crores. It is 1.94 crores, which means her fixed 7% interest payment for year 11 shrinks. Her income drops to roughly 13.5 lakhs. But does inflation care about her shrinking principal? Absolutely not. The cost of her lifestyle continues to compound upwards, let's say to 21.5 lakhs. The jaws of the trap are just opening wider. Her income shrank, but her expenses grew. So her shortfall isn't 6 lakhs anymore. Now she's short 8 lakhs. She has to withdraw 8 lakhs from her principal. Heading into year 12, her corpus drops to 1.86 crores. Her interest income plummets further. And her expenses? They keep climbing. The next year, she has to withdraw 10 lakhs, then 13 lakhs, It is a terminal velocity feedback loop. She is literally cannibalizing her own capital just to buy groceries. The data shows exactly how devastating this acceleration is. By year 15, Mrs. Sharma's original 2 crores has imploded down to 1.1 crores. She has lost nearly half her life savings, and her living expenses are higher than they have ever been. And this triggers an entirely new psychological terror: longevity risk. Longevity risk is the very real fear that your biological lifespan will outlast your financial lifespan, basically outliving your money. It's the stark realization that you are going to be alive but entirely destitute. And what happens when someone's back is against the wall like that? They panic. To slow down the death spiral, Mrs. Sharma makes some really desperate cuts. She downgrades her living situation, which is painful enough, but then she does something truly catastrophic. She cancels her medical insurance because the premiums have gotten too high. That is the worst thing she could possibly do. By dropping her shield to save a few thousand rupees, she leaves herself completely exposed to the 14% medical inflation final boss, exactly when she is aging into her highest risk medical years. If she slips and breaks a hip or needs a stent, the hospital bill will instantly vaporize her remaining 1.1 crores. Instantly. She thought she was playing it safe, but her strategy created a 100% probability of financial ruin. Now, let's take a breath and look at Mr. Gupta. Did he survive the decade? He more than survived. Despite the inherent volatility of his 60% equity allocation, despite periods of volatility and negative returns, the long-term average came to approximately 13% over 10 years. Like Mrs. Sharma, he was taking money out every year. The difference was that his portfolio was growing faster than he was withdrawing. After 10 years, his initial 2 crores had actually grown to 3.8 crores. His purchasing power is stronger at age 70 than it was at age 60. He is traveling, fully insured, and has zero anxiety about outliving his money. Okay, but we need to address the elephant in the room here, the giant, terrifying, market-crashing elephant. A fair concern remains: what happens if a major market crash occurs right after retirement, exactly when withdrawals begin? Yes, he absolutely would. You are identifying the most critical risk in retirement planning. It's called sequence of returns risk. And to understand it, we really have to look at the difference between how you accumulate wealth and how you consume it. During your working years, when you are investing a portion of your salary every month, your SIPs, market volatility is actually highly beneficial. When prices fall, your monthly investment goes further. That's one of the key advantages of investing consistently through market cycles. That's rupee cost averaging in action. Market declines allow long-term investors to accumulate more units at lower prices. The order in which the good and bad years happen does not matter at all, as long as the long-term average is strong. But the mathematics flip entirely the day you retire and begin consuming that capital. The game changes completely. This introduces sequence of withdrawals risk. Let's look at the nightmare scenario. If the market crashes 30% in your first year of retirement and you still need to withdraw 10 lakhs to pay your bills, you're forced to liquidate investments during a downturn, locking in losses at unfavorable prices. You are locking in the loss. This specific destructive mechanic is called rupee cost ravaging. Selling heavily at low prices permanently reduces the amount of capital that can compound in the future. So even when the stock market eventually recovers and hits new all-time highs a few years later, you don't have enough units left to ride the wave back up. The engine is broken. Long-term averages don't tell the whole story. A large loss at the start of retirement can materially alter the outcome when regular withdrawals are involved. Imagine two retirees with identical portfolios, each achieving the same 10% average return over 20 years. But if retiree A gets all the market crashes in their first 3 years, and retiree B gets all the crashes in their last 3 years, retiree A dies completely broke and retiree B dies a multi-millionaire. The sequence matters way more than the average once you start withdrawing. So, how did Mr. Gupta survive? If he had 60% in equity, why didn't a bad year ruin him through rupee cost ravaging? Because he didn't put 100% in equity, he had 40% in debt. He built a structural buffer. That buffer allowed him to dictate exactly where he pulled his living expenses from, rather than being forced to sell his stocks at a loss. We are going to dive deep into exactly how he engineered that buffer in a minute, because it is the ultimate wealth hack. But first, we need to pause and ask a fundamental question. If the math is this clear, if the 14% growth of the Nifty so thoroughly destroys the 7% FD over a decade, why are the vast majority of Indians still acting exactly like Mrs. Sharma? Why do we voluntarily walk into the retirement death spiral when the data screams at us not to? Well, welcome to neuroscience. At this point, the math is no longer the main problem. Human behavior becomes the deciding factor. Human psychology was shaped for survival, not for making optimal decisions in capital markets. At the heart of this issue is loss aversion, the idea that losses tend to feel more painful than equivalent gains feel rewarding. According to loss aversion, losing money hurts disproportionately more than making the same amount of money feels good. Here's a simple thought experiment. You're out for a walk and come across a crisp 2000 rupee note. You get a nice hit of dopamine, you feel a little burst of excitement, and you move on. Awesome day, right? Maybe you buy an overpriced coffee. Now, imagine you reach into your pocket and realize you dropped a 2000 rupee note somewhere. Your amygdala, the fear center of your brain, lights up like a Diwali sparkler. You feel genuine anger, stress, and anxiety. That's loss aversion in action. The pain of losing the 2000 rupees would probably outweigh the happiness of finding it in the first place. In a survival environment, preventing losses was often more critical than securing additional rewards. Our brains treat financial loss as a mortal threat. So how does this biological wiring sabotage Mrs. Sharma? Because of loss aversion, Mrs. Sharma cannot tolerate the visual reality of a fluctuating portfolio. The red numbers hurt her brain. If she invested 1 crore in the Nifty 50 and the market dipped, her app might show her balance drop to 90 lakhs. It's just a paper loss. Even though she hasn't sold anything, her amygdala triggers a panic response. The pain of seeing that red number would literally cause her insomnia. To avoid that psychological pain, she seeks refuge in the FD. Because the FD only ever goes up. It never shows a red number. The FD provides immediate short-term emotional comfort. She feels perfectly safe. But as we saw, she is trading short-term psychological ease for guaranteed long-term mathematical ruin. She is still experiencing profound loss. But because inflation is invisible and happens slowly at the grocery store, her brain doesn't trigger the alarm until it's way too late. It reminds me of people who stay in incredibly toxic relationships just because it feels familiar. They ignore the steady, reliable red flags because they are terrified of the short-term drama of a breakup. We stay in toxic financial relationships with inflation losing assets because the illusion of safety feels better than the reality of volatility. And that leads directly into another major cognitive bias. This is a big one, mental accounting, developed by Richard Thaler. Mental accounting is the human tendency to compartmentalize money into different psychological buckets, treating the exact same currency entirely differently. So, for example, if I get my monthly salary, I treat that as serious money. I budget it for rent and utilities. But if I get a Diwali bonus from work or a tax refund, I categorize that as play money. And somehow, I spend it almost immediately on something I probably didn't need. Even though the money is worth exactly the same, it doesn't feel the same. In the context of Indian investors, the studies show this manifests dangerously. People designate their FD as their sacrosanct savings. They refuse to take any risk with it. But then, if they decide to enter the stock market, they use their extra cash and treat the market like a casino. They seek out incredibly high-risk speculative bets, hoping to double their money overnight. They don't view the FD and equity as two gears in one machine. No, they fracture their wealth. Absolute safety from one half and pure lottery ticket returns from the other, which perfectly explains Gen Z behavior during the pandemic. A powerful mix of FOMO and herd behavior helped fuel the influx of retail investors during the 2020 recovery. They entered a market that was rebounding sharply. They saw charts going straight up. This triggered something called recency bias. People often project recent experiences forward, assuming current conditions will last much longer than they actually do. Because of that recency bias, they poured capital into highly speculative assets, unregulated crypto tokens, volatile penny stocks, leveraged derivatives. And when the market inevitably normalized, they got completely wrecked. They were playing a totally different game. This ties right into another fatal brain glitch the sources highlight: anchoring bias. This one is brutal. Anchoring is the tendency to become fixated on a past price or value and judge everything else relative to it. The study mentions the Yes Bank collapse as a primary example. It was once a high-flying stock trading at nearly 400 rupees. Due to severe fundamental issues, the core business collapsed and the stock price plummeted below 20 rupees, from 400 to 20, a total wipeout. But retail investors, suffering from anchoring bias, looked at that 20 rupee price tag and thought, wow, this is the deal of a lifetime. They bought millions of shares of a fundamentally broken bank. They anchored to a ghost of the past, completely ignoring the reality. So our brains are essentially a minefield of cognitive errors, whether it's Mrs. Sharma anchored to FD safety or a Gen Z trader anchored to a penny stock. So how do we invest with discipline and confidence even when the market is giving us every reason to panic? We need a system that bypasses our emotional triggers entirely. Welcome to the ultimate wealth hack, the retirement bucket strategy. It separates your capital based on when you are going to spend it. Let's break down bucket 1. This is your liquidity bucket. Its sole purpose is to fund your immediate lifestyle for the next 1 to 3 years. This money sits in absolutely safe, highly liquid assets. This is exactly where Mrs. Sharma's FDs belong. And the psychological power of bucket 1 is immense. When the market falls sharply, the bucket strategy gives you time. Instead of reacting emotionally, you can let your long-term investments recover. Why? Because your essential expenses for the next few years are already covered by cash and low-risk assets set aside in advance. His strategy works because it reduces the risk of being forced to sell investments when markets are weak. After a few years, the first bucket needs to be refilled. Bucket 2 exists specifically to serve that purpose. Think of Bucket 2 as the buffer between safety and growth, designed to support your spending needs over the medium term. It acts as a reservoir. Periodically, you take the moderate profits from Bucket 2 and flow them down to refill Bucket 1, which leaves the core engine, Bucket 3. This is your growth engine, the capital you will not touch for at least 10 to 15 years. This is where you deploy your Nifty 50 index funds. Because you have a 10-year time horizon, short-term crashes are completely irrelevant. This bucket is built for long-term growth, helping your portfolio stay ahead of inflation and supporting future withdrawals. But remember, you must adjust your withdrawals. Pulling 7% a year is suicide now. Modern planners suggest a safe withdrawal rate of 3.5% to 4.5%. The bucket strategy is the ultimate cheat code because it forces a paradigm shift. It moves your focus from nominal protection to purchasing power protection. It gives you the emotional comfort of Mrs. Sharma combined with the mathematical survival power of Mr. Gupta. Don't be a Mrs. Sharma. Now, before I sign off, I want to introduce one final, genuinely provocative concept from billionaire Ray Dalio to leave you chewing on. Over the last 500 years, examining the rise and fall of global empires, every single major fiat paper currency created by governments has eventually been debased. When governments have unpayable debt, they print more money, flooding the system, killing the value of your cash. So the reality is, the thief isn't kicking down your front door. The thief is built into the architecture of the house. Thank you for joining me. See you next time on The Deep Dive.